Hello and welcome to Options Guide TV. My name is Brian Overby. I am the author of the Options Playbook, and I'll be your host here for about the next half hour or so. And with that said, this is a very interactive show. So if you have any questions and you are watching on the YouTube platform, please do put them in the chat box and we'll try to answer them at any point in time during this show. So on Monday, and the theme of Mondays has been iron condors, mainly because we've talked many times about the woes of Congress and the marketplace really just trying to wait till we get some news out of that. We've had a lot of geopolitical concerns. There's always still talk of recession. The Fed's coming out in November. November 1 is when their next announcement should be about the Fed's funds rate. And the probability has dropped precipitously that they're going to raise by a quarter of a point. But we are still in October. September was, once again, not a very good month for the markets. And so trying to get through this period until, first of all, Congress gets their act together and gets a budget going for the United States government. And on top of it, gets a Speaker of the House elected. I don't really see the marketplace going anywhere. And that's really been the theme for almost since the middle of September that we've been talking about on Options Guide TV. So every Monday, we've gone out and looked at an iron condor, which is a neutral strategy on options. We've been doing these in either the SPY or the SPX. Today, I am inside the TradeHawk paper trading platform. And I am looking at the SPY that we put together on Monday. Now, we started by doing a longer term iron condor, which I think is the more standard way that I would approach iron condors, going out about 45 days in time and then selling somewhere between the 20 and 25-day period. That's if everything goes well. And then we looked at a little bit shorter. We went down to about a 30-day iron condor. And this week we got really crazy and we went out and did a weekly iron condor. So I'll review that trade on Monday that we put together in the SPY. And then we're going to try to add a stock to our portfolio. So even though the market has been, I don't know, lack of direction, it would be, I guess, the best phrase to use. Hard to get bullish in this marketplace, but we're still going to. And we're going to do that by managing our risk. So I've decided that I'm going to slowly put a portfolio of deep in the money options together. And we're going to start out by focusing on the Magnificent Seven. We're going to throw in a couple of banking stocks, which are going through earnings right now. The earnings season has kicked off. And as a matter of fact, even in not the Magnificent Seven, but I guess this is a part of the hangover on the FANG stocks. We had Netflix announce earnings today. So they're starting off the big tech, mega tech earnings reports. Netflix usually the first one that will come out and do that. So we're going to just take this momentum. And NVDA has been beaten up ever since their earnings, actually, which they knocked out of the park once again, blew away all estimates. But the stock is down since then. And one of the biggest things today is the U.S. is tightening curbs on exports to China. Kathy Woods came out and said that she would rather have Tesla than NVIDIA, wanted to sell some NVIDIA to buy some Tesla. Whatever it is, we're going to try to take advantage of it. We're going to have a longer term outlook on the underlying stock. They do not announce earnings until the 21st of November. So it's going to allow us to sell a call against that position. So we're going to put our fig leaf on. And that's what we call the strategy inside the options playbook. Some people will call it a leverage covered call. We always like to say, well, you don't own the stock. And since you don't own the stock outright, and if you were assigned, well, you got some problems there. And we like to say you're kind of covered. And that's where the term fig leaf came from. And that name has kind of taken off a little bit. But so we're going to we've been putting a portfolio. We started with Google, bought a deep in the money call option on Google, and Google has gone basically nowhere since we did that. And we've sold a couple of covered calls against that. Well, I guess fig leaves, it would be a better way to say it. So we've sold some calls against that deep in the money call option. And now we're going to try to duplicate something very similar in NVIDIA. So I'm getting a little bit ahead of myself. Let's go back and look at what's going on in the SPY. Now, we put it on Monday. the VIX was trading right around 18, and we still see the VIX there. And I don't think the VIX is going to move that much until there's a little bit more clarity on what's going on in Congress. Not to mention, we have all the now you got to say geopolitical concerns across the world, not just in Ukraine, obviously. So with that said, there's still a lot of landmines out there, and the marketplace is nervous, and we're seeing that being shown in the VIX up around that 17 level. I could actually make a case for the VIX to be higher than that, and if I were to do a VIX trade, I'd be buying VIX calls as opposed to buying VIX puts, because I do think that that market could take off. All right. Other things that we've talked about. Well, let me look at the SPY, and then we'll talk a little bit about the long straddle that we're trying to set up. Okay. All right. So here we have the SPY is trading at 432.39. It's down a good bit today, almost 1%. That's a solid move in the SPY. It doesn't usually move too much more than 1% on any given day. So that's a strong move just in general. But the trade is still hanging in there. What we looked to do was the October 23rd expiration. So that's actually for the NVDA trade. So I'm going to run all the way back to inside the TradeHawk software, the October 23rd expiration is what we were looking to do, 5 days away. And what we looked at selling here, there it is. Okay, 1023. So we looked at selling the 445 strike call. So that's a little bit, it's more than a 1 standard deviation move away. So on this side of the equation, we might think about getting out of this call. Right, so we sold the 445 and we bought the 450. Let me put that in there. So right now we can close that trade out for $10, for 10 cents. And that's very feasible to do. Market, like I said, has made a fairly strong move to the downside. If I can close and take this risk off the table for 10 cents, we sold it, we got about 85 cents. And I think we sold this thing for closer to 45 cents. So we're got a decent gain on this side of the trade. But now let's go and look at what's going on the other side. So that's a dime to remove that risk, which means that we're going to be losing on the other side of our trade. And let's see where we're sitting at on that underlying position. So 426, we sold that one. And then we went 5 points down and bought the 421. And there we go. So right now we're still up on the trade. We sold it for 84 cents, 86 cents total. The market has made a move, but we're only got a week trade, or we're only going out to October. We only got 5 days left. We're only going out to October 23rd. And because of that, the time decay is very large on all of these option contracts, especially from Wednesday to Friday. We're going to see a lot of time decay going on in that trade. So we could remove the trade and only make 7 cents, but I don't really want to do that. So on my paper trade that I would have done on this trade right now, I would want to remove the risk on the upside. So right now we're doing okay. 426, we're still got 6.5 points to the downside before we really start getting nervous on our put side of things. Our call is trading for under 15 cents. And that's usually, if I can get around 90% of the premium on the short spread, I don't mind closing that out ever. That's never a concern to close out a short spread if you have made 90% of what you could possibly bring in. So 10 cents, I can't get much lower than that. It's going to be a battle to get that down to 5 cents. So instead of trying to manage that risk on the call side of things, let's just close that out. So here's how we're going to do that. Okay, so let me go in and remove our put side. So here's our put side of our trade, the 426, 425. I'm just going to remove that. And I don't have this position on in this actual test account right now. So I'm going to have to just reverse the way that we put it in. So we sold to open to put it in. We're going to have to buy to open. It's going to say open instead of close on that leg. And then we're going to sell to open as opposed to close. And right now it's saying the midpoint is at 9 cents. The markets are really strong. I think we could close it out at 9 cents. So our order would be, we're going to buy to close the October 23rd, 445 strike call. And at the same time, we're going to sell to close that October 23rd, 450 strike call. We're going to try to do this for a net debit. Let's call it 10 cents. It's bouncing around. Just make life simple of 10 cents in that account. Remove that leg. Now all we got to deal with is the put side of things. It's gone against us a little bit, but it's still not doing bad. And here it is Wednesday. And we got until October 23rd, about 5 days away. All right, simple. Now, let's move on to setting up our portfolio. And we do really want to avoid earnings as much as possible. So looking at Amazon or Apple, if we were going to add one of those stocks, they're going to be announcing earnings next week. And I don't really want to pay that volatility premium if I'm looking at a longer-term portfolio. On NVDA, we're not seeing earnings until the 21st. So you'll see a little bit of a movement in the volatility on the NVDA options, but we're still not in that crunch time where we really see volatility spike. And so I don't mind doing that trade. And we'll look at other stocks. Ideally, they announce earnings and then we look at buying the longer term options. So we'll slowly add stocks to this portfolio, and then we're going to track it throughout the year. That's the way that we're going to look at these positions. So let's go to NVIDIA. And once again, if you have any questions, just toss them in that chat box, and I'll be happy to answer them during the show, if possible. All right. All righty. NVDA. Like I said, it's down $15.50, about 4%, which it's not a big deal in NVIDIA. 4% move do happen from time to time. On the way up, they was jumping in 10 and 15% moves to the upside. So we've came off a little bit since their earnings. They were trading right around 440. Made an attempt to get up to 500, but it was only there for a second before it started dropping all the way back down to where it was right around earnings. And now we see it below those levels. So right now it's trading at, and earnings from last quarter. Right now it's trading at 424. So we're going to go all the way out. Once again, our Google position that we put on went all the way out to 2024. So I'm scrolling inside the Trade Hawk software. In the options grid, we're going all the way out to January is what I want, not June. January, 457 days away. And as always, when we're setting up a fig leaf or we're buying a deep in the money option contract, if you can afford to go out to the next year, January 2025, I think I said 25, always prefer to do that, because then that gives you an option. If you did stay in this position all the way out and you were not in a IRA account or you're in some taxable account, it gives you that opportunity to try to put off gains into a new year. So not tax advice here on Options Guy TV, but I always you'll see a lot of people that will trade those January options. And a lot of time, because of that, you see more open interest, which usually means a little bit tighter markets. Now, that's the biggest issue about buying deep into money options, is trying to find an option contract that's trading for a decent price. So on this case, consider that we were going to buy 100 shares of NVIDIA. So right now it's trading at 423 times 100. We're talking about $42,300. We're going to go down and look at an 80 delta call option in this expiration. And to get to 80, we're looking at about the 305. Okay. So that's $165 underlying. So 165 divided by 423 is looking at about 40% of that underlying stock price. So 160, that seems a little high, but that's probably about right. So and that's 80 delta. We're highlighting it here right at 305 divided by 423. Double check my math. Yeah, 40%. So we're putting up 40% of the underlying stock price to get at that 80 delta. I think I'm going to go a little bit higher. Let's go down to about the one. Let's give ourselves $10 here, and let's do the 320. We're still talking about a 77 delta. We're not quite 78, but by doing that, we're saving ourselves $10. Now, we still got a lot of intrinsic value on this option contract because of the juice that is out there, but this is going to be the option contract that we're going to do in our paper trade. And so now we're going to cut that down a little bit. So 150, so the 320 strike is going to be our ask. I'm going to click on that, put that in the right rail. Looks like I'm frozen a little bit here. Give me it. There we go. I clicked on it twice. So 155 then divided by 424, we're looking at now about 36%. I'm going to make a note of that. 36% of the total stock price right now, we're going to put up to try to buy this option contract that's going to go out to January 2025, 457 days from now. Now, once we do this, that's obviously a lot of time premium that we're going to have to try to wither away at. If we get the upside move, we get a strong move to the upside closer to the 500 level, we'll consider getting out of the trade. Now, one of the biggest things about buying deep into money option contracts is that if you get the move, you're really going to want to get out. I don't have any problem with the fact that you bought it in October and you sold it in January of next year, and you sold it in the short term because you had a big, strong move to the upside. I'd look to find another underline to get back in on, but it's not like owning a stock where you just want to sit there and just hold it for the next 10 years. We have an expiration date. It's a long time out, 457 days. But if you get that opportunity, that's more of I guess, long-term swing position is the way that I would, is a good phrase to use. All right. So buying that option contract. Now we're going to go all the way up in the short term, and we do not want to be in a covered call around earnings. So the earnings are on the 21st of November. Well, it's indicated to be somewhere around that. We're not going to have to go out that far by any means to get premium in this underlying. So November 3rd is 16 days away. So now I just clicked on that and I moved our option contract to our option grid to this expiration, and I'm highlighting it over here in the left rail. And if we scroll up, we want to go at least one standard deviation out of the money, but we can get a lot of premium for this one. So looking at where the Trade Hawk options grid is highlighting a one standard deviation move, which is somewhere between 460 and 465, taking a peek at the delta, seeing that right around 16%. That's usually where the delta would be on a one standard deviation move. So I'm agreeing with what the Trade Hawk software is implying the one standard deviation move is. So you got a 16% chance of that underlying finishing above that the 465 strike. Okay. $3. It's a lot of premium. Don't quite need that much premium because we didn't pay as much for the underlying. If I own the underlying stock, this would probably be the option contract that I would sell if I was looking to do the covered call position. But instead of that, I'm going to look at, let's do the 470. I'm debating if I want to do 470 or 475, but we did pay a lot of premium, and we had to because of the volatility nature and the nature in general of NVIDIA. So I'm looking at doing the 470, and we're going to bring in $2.36 on that. So 240 by 236, a very solid market. We'll click on that. And this is our paper trade. This is our fig leaf that we're going to put inside our portfolio. And we are looking to buy to open the 2025 January 17th call option, 320 strike call in NVDA, and at the same time sell the November 11th, 2023, because I probably need to emphasize that, 470 strike, and we're going to sell that for approximately $2.28. But the net of our entire gaggle of securities is going to be $152.65. So we're talking about, instead of 43,000, we're putting up $15,265 to get into this position. And that will be our paper trade for the week. All right. So with that said, we'll probably look at on Friday, we'll look at some of the earnings that are coming out for next week and get prepared for that. We'll try to find some underlyings that aren't part of the Magnificent Seven to add to our portfolio. We're going to do maybe 5 or 6, depending on what the feelings are in the marketplace. And we're going to build this portfolio of stocks going into the holiday season. Still nervous about the market, but I don't mind trying to build this portfolio where we have limited and known risk on these underlying stocks. We're going to keep selling calls against them until we don't. We get a little bit more bullish. We might slow down on the calls. We're going to be avoiding earnings. So if we are buying a stock that's going to be announcing earnings in the near term, we're going to try to avoid that. But if we are, well, we're not going to be selling a call. We're going to totally avoid selling calls around earnings. Because here's the biggest thing about a fig leaf is you don't own the stock. And hence that's the name why we like to say with the fig leaf, you're kind of covered. You don't own the stock. And if you get assigned, you got to do something. You got to sell that longer term option as opposed to exercise. And you got to go out and buy the stock, and it gets messy. So you really want to avoid assignment. And that's going to be a big part of this management process that we're going to try to maintain throughout the next year on a lot of these deep into money call options. All right. If you have any questions, please put them in the chat box. And if not, then I guess this is going to be it for this edition of Options Guy TV. We will be back at Friday at 11 a.m. Eastern time, and we'll review our trades and start to think about earnings in the Magnificent Seven that are going to be coming up over the next couple of weeks. So please click subscribe, ring the bell, pound that thumbs up, and we'll see you this Friday for the next edition of Options Guy TV. Thanks for coming, everyone.